Hello, everyone, and welcome to another Dolphin Financial Radio Show. Today's topic: should you pay off your mortgage when you retire? In this country, a lot of people have debt, but in past generations and even today's boomer generation, debt is an enemy, and having a mortgage seems to be a strike against your retirement character. So, we're going to talk about that, whether or not it makes sense to actually pay off your mortgage. Let's bring in my co-host Tony Shore to talk about this. Welcome to the show, Tony. Paying off mortgage. Do you agree that our parents' generation and even more so their parents' generation were against any sort of mortgage debt, any debt into retirement?
Yeah, for the most part, I think a lot of people, I don't know for sure, to be honest. I never really discussed it or heard my parents or grandparents talking about that. I know that they've, very against debt in general, but I don't think so. I mean, my parents' situation and my grandparents' situation with their homes, they built them and they never really paid mortgages on their homes. So that's a unique situation. They lived in the
So you
country
basically you basically took it to the next level. Not only did they not have mortgages, my parents built their houses. So these new generation
from
boomers.
scratch. Yeah, yeah, from scratch. My dad and his dad and brothers built my grandpa's house and my mom and dad's house across the lane. So and they're still living in them. But there's property tax. It's a big farm. I'm sure they pay in on
Right.
that. But mortgages, I would say, a lot of people worry about no debt. They listen to Dave Ramsey, and you can't have a dime of debt. You don't want to owe
Right.
anybody anything, right?
And there's nothing wrong with that. I mean, debt-free retirement. I mean, what's not to like about that?
Right.
Um, and it's really a positive thing. But sometimes it might not be. And I've run into a couple of cases, scenarios lately where people paying off a debt look to be a bad mathematical decision. So I want to talk about
Interesting.
it.
It's all about the math with you, Dan.
Well, it really is. But spoiler alert, sometimes math gets in the way of real life, and real
Huh.
life gets in the way
Sure.
of good math.
Speaking
So
of real, I believe those $100 bills behind you are counterfeit. If you look closely at
yes, if you're
don't
looking,
try to spend those, Dan.
sorry if you're listening, but if you're looking, it looks like there's a guy with a beard and a mohawk in the place
Yes,
of
it
Benjamin Franklin on the
it
$100
does.
bill.
That's what I was looking at.
But it could be an early rendition of Ben Franklin, so
Oh, it
you
looked
don't
more like
know.
Lincoln to me from the side,
It
but just with more of a brewmaster's beard or a lumberjack beard.
Nothing to say about the little house on the other side, so we're talking about paying
Yeah.
using this to pay off this. Ooh, I'm
Yeah,
reversed
got
here.
it. Yeah.
So, um, paying off a house as you're entering retirement makes a lot of sense, especially when it comes to cash flow. Because if you think about it, one of the biggest expenses besides taxes is, in retirement could be your housing. Housing, food, transportation, those are the big 3. So if you pay off your mortgage and you don't have that house payment anymore, that really frees up a lot of cash flow in
It
retirement.
it does.
So people like that. And I'm not gonna begrudge people for paying that off. But here are a couple of factors. I wanna go through some factors to think about before going and paying off your mortgage. The first one, what is the interest rate on the debt? Now, mortgage rates are slowly going up, or actually quickly going up, I should say, but they've been so low recently. Um, you refinanced? I have clients that have refinanced and have mortgages at 2.5%.
Mm,
You can get a 30-year at 2 you can run into someone that's sub 3, a lot of people with a 30-year mortgage or 20-year mortgage sub 3%,
yeah.
which is historically quite low.
Yeah, I think
So
ours is like 2.9.
right.
Yeah.
So you gotta know your rate. So that's the first thing. So then it begs the question, Tony, if you're paying 2.5% on your mortgage and you're investing that money and making 5% return, double that, does it make sense to actually pay off the mortgage using that money that's making 5%? This is the math coming in. Hey,
Yes.
I'm paying you 5%. You're paying Joe 2%, 2.5. Should you stop the money that I'm getting at 5% to pay off Joe at 2.5? I don't know. You're
That's a
losing
good
two and a
see,
half
it
percent at this point,
yeah.
right?
Yeah, so if you do the math, so in certain situations, what you're saying is there are certain scenarios where the math makes sense to you'd rather have that mortgage and be paying off a
Right.
mortgage.
Especially if you're getting a higher return elsewhere. Significantly higher return, I might add, double. However, there's some risks associated with a 5% return right now. Now, that's not to say interest rates are gonna creep up and you say you locked in a 30-year rate, okay? Say you're 50 years old and you have 20 years left on a mortgage, and you're like, "Well, I plan on paying this off by the time I retire at 62." 12 years from now, what if you can get a CD paying 6%? That's not
Hmm,
unreasonable, right? And you're paying 2.5% on your mortgage. If you Does it make sense to sell the CD that's paying 6% and pay, So I think what's gonna happen going forward is people are gonna be looking at their mortgage rates and saying, "Man, that's really low. I can
yeah,
get a better return elsewhere." There's always risk associated with the other return, but if you can get a risk-free or close to risk-free, there's no such thing as risk-free, a close to risk-free return that's higher than your mortgage rate, why would you pay it off?
sure.
That's so it's a factor to consider. Um, Along those lines, another factor is other debts. So I was looking in our archives, Tony. We did a show on this very topic over 3 years ago, and we talked about these same things, but I figure we'll refresh because of the current interest rate environment. But
Right.
one thing that was true back then and one thing that is still true today is if you have other high interest rate debts, such as a credit card, don't pay off your mortgage before you pay off the credit cards.
Mm,
So, as an example, it's very reasonable for someone to have a credit card debt of 20% interest,
yeah. Yeah, it can go all the way up to like 24, 25 per 24%, I think is the
right? It could
yeah,
be 30 in the future. Who knows, right?
yeah,
So if you have a 20% interest rate credit card debt of say $10,000
yeah,
and you're saying I want to pay off my house because I want to retire, or I'm going to make an extra payment on my home loan so that I can get rid of this earlier. That's all part of my plan to be debt free in retirement. Don't forget about the credit card payment
yeah.
or the auto loan or some other debt.
So the math says pay off the highest interest debts first. That's what you're saying.
Absolutely. That makes the
And
most
that
sense to
includes
me.
your mortgage, and people sometimes separate their mortgage from other debt, and what you're saying is don't think that way. Look at any debt and
Right.
then prioritize what you need to pay off first, and
That's
the
right.
thing that's charging you the most interest has to go first, and any money you'd put toward paying off anything else should go into that one first, because
That's right.
financially, that's going to help you the most.
Right. Now, this also goes into back to the first one, which is the interest rates on debt. Um, what if your money is in a bank right now paying 0.01? Is that why do you have that bank account with 30,000 at 0.01 sitting there for no purpose? This is outside of your emergency fund.
Yeah. And you've seen that
Wha
people actually do that sometimes, don't they? Have a large chunk of money in a bank paying no
Right,
interest
just
or little.
waiting there, or even a CD paying point 0.5. And the question is, well, why wouldn't you just apply that to your debt? Why not pay off
Yeah,
your mortgage with that? So
yeah,
it goes both ways. So the
because 'cause you're
math
losing
suggests
money by
right,
yeah,
you're right. So if you're getting 0.5% from the bank and you're paying 3% on the mortgage, doesn't make sense.
right,
Reallocate the funds. So back to the interest rate, hey, if you could do better, why not? At the same time, you could do better by paying off a 20% loan, right? That's pure profit at that point.
yeah.
Okay. Another factor, and this is the one that I've run into recently, is your payoff money taxable? So, Tony, you owe $50,000 on your house. You're 64 years old. You want to retire next year at 65. You're like, I'm paying this off. I'm paying off this 50,000 because I'm done. I don't want the mortgage payment anymore. I just want to be debt free because that's what I'm supposed to do. So you go to your IRA because that's where your money is. That's where you have all your money, and you take 50,000 out to pay off the loan of 50,000. What's the problem with that?
You're going to be taxed on that money, and that's going to be counted as income, and so it's going to drive you into a higher income bracket, right?
Tony, take over. Keep going, man. You're on a roll. There it is. You're right. That's it. That's it. So I've run
Right.
into some people recently that just out of control desire to get rid of their debt. And hey,
Yeah,
it's not a bad thing, right?
sure.
But for whatever
They've
reason,
been
debt,
listening to Dave Ramsey,
right, right, which is I'm all for it, right? I'm all for debt reduction and so forth. But you got to be
especially
smart about it.
credit card debt reduction.
Right.
Yeah.
So this was I want to pay off my mortgage. So I'm going to use up all my free cash and I'm going to take out the balance that I need from my IRA. And what happened was they got taxed on the IRA because
Mhm.
that's what happens,
Sure.
and they used all their cash. So not only do they have a liquidity problem, they have a tax problem. And now that tax went from the 10% tax bracket or the 12% tax bracket to the 22% tax bracket. So by creating that income, they were on the border. That income they took out was 22% versus the 12. So that's a 10% increase in taxes to pay off a 3% mortgage.
Hmm.
Doesn't make sense to me,
No, it
right?
doesn't. Nope.
Especially if you could spread that tax burden out in the future. Another client, not client, but I ran into someone that who did this. They wanted to pay off their house so early that they took money out of their IRA prior to 59
Oh,
and a half,
come on.
and they had a 10% early, what's that called again? Do you remember what we called the 10% if you take money out of your IRA before 59 and a
10%
half?
early withdrawal penalty?
Early withdrawal penalty, but you know the technical term from it was, Tony, it's actually a tax. It's an excise tax. Remember that? We talked about the
Excise.
excise tax.
Excise tax,
We did a
yes.
show on taxes, and
Wait,
that
I'm
was one of
supposed
them.
to retain this stuff you're teaching me?
No, you're not. That's why I put, reminders up here for people.
Yes.
So here we go. I want no debt in retirement, yet I'm gonna make financially I'm gonna say not stupid because, just
Right.
poor financial math decisions
Yeah.
to pay off my debt.
Mm,
There's other ways to do it. Kinda like
yep.
we did the Shawshank Roth, the Shawshank
Yeah.
Roth conversion.
Yeah.
Let me convert it all at once. No, why not convert it over
Mhm.
time?
I know that's what you wanted to call your book, The Shawshank Roth Conversion, but
It still might be,
Stephen
Tony. Don't
King
don't don't
Stephen
ruin
Stephen King's lawyer sent you a cease and desist.
The idea of that is you pay off a little bit or you convert your Roth over time to reduce the tax burden over time. You could do the same with paying down your mortgage. Maybe instead of doing a lump sum, get it done, I don't want any debt in retirement. Maybe you increase your payments a little bit so you're not bumping yourself into the next tax bracket. It's just being
Ah.
smart about it, right?
Do the math.
And
And here's the deal, you don't but people are like, "How can I think of all these things, when I'm making this decision?" Well, that is exactly why you need to work with a trusted financial services professional who's a fiduciary, who's looking out for your best interest, and knows to look out for these things and sit down and do the math. I mean, I know
yeah,
that's what you do for your clients so they don't make these mistakes and end up losing out and losing
right,
valuable resources or getting themselves into a bad tax situation.
right. It's like um I would take it a step further and say look for a CFP, certified financial planner. That's going to look at the big picture stuff, not just
Yeah,
focus on investments, not just
right.
focus on insurance, everything. And that's because
Yes.
this falls into that, everything category.
Right.
Another factor
Stuff
is,
like Social Security, healthcare,
right,
Medicare, and tax.
long-term care qualifications,
Yeah.
your home equity factors into that.
But
So,
debt reduction is another thing that most so-called financial planners won't always help you with, or your stockbroker, or a lot of so-called financial professionals aren't looking at the big picture.
Right. Now, on the flip side of that, a lot of financial advisors say, don't pay off the house, use that money and invest it with me because I could do better. Whose best interest are they looking for? So
Yeah,
sometimes it does make sense to pay off the house. Um, Liquidity is a big factor too. Are you putting all of your money? So if you're paying off your mortgage, Tony, what you're fundamentally doing is taking money from one asset, whether it's in the bank or in the stock market, and you're
sure.
moving it into another asset, which is your house. So you still own that money. It's not like it's just you're paying off someone and you don't have anything to show for it. Your house becomes more valuable in terms of
Yeah,
equity,
you've got
right?
equity, yeah.
Right. So you have to remember you don't want to put all of your liquid money into the house because then you're going to be house rich, cash poor. And that doesn't help with retirement living
Right,
expenses if all your money's stuck in the house. So if you're
right.
going to pay off your mortgage, which is perfectly fine, you have to be willing to look at your house as an asset as well if you need it. You might consider a reverse mortgage or a home equity line of credit. You might have to tap into your house in the future to help live. And
Okay,
people
Magnum PI, Tom
we're
Selleck.
afraid of his mustache, I know.
Yeah.
So so people are afraid of debt. Reverse
Right,
mortgage is just another mortgage, just debt. So
yeah,
a home equity line of credit is another debt. So if you're going to pay off your mortgage only to have to go back to it later, what's the sense of that? Maybe the
yeah,
rate for the 20 years left on your mortgage was a better rate than you'd get with a reverse or a home
yeah,
equity line of credit. Last but not least, Tony, the last psychological factor, the factor is psychological aspect of paying off your house. This is something that I will just say you can't underestimate the value of. Um, there's a really good feeling of being debt free.
yeah. We talked about stress last week or the week before,
Yes, last week,
and,
last week's show. I'll put it
last
up
week's
here.
show is about stress,
Stress.
and, that's one great way to reduce stress is being debt free, that's for sure. I mean, that's financial stress is the number one stress people have, typically.
Right. Right. So a conversation might go like this. All right, Tony, your mortgage is 2.9%. We found a financial product that's pretty solid that can give you 5. So you're going to make 2.1% net. Okay, Tony? Um, do it, right? That you just buy the
Yeah,
product but you come back and say, I don't want that.
yeah.
My job as a fiduciary to factor in this feeling because
Your risk and debt adversity.
right, is
You're
2.1%
enough.
enough to 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 offset the stress that perhaps you and your wife are feeling. Maybe you're fighting about the debt.
Yeah,
Maybe you just wake up every morning with feeling like a heavy weight on your chest because you got to pay that mortgage every month. And you're like, I just want to be done with that. And that 2% extra you can get, it's is it really worth it? Maybe not. And that's the type of conversation. So this is where math and life kind of clash sometimes.
yeah,
I could talk math all
good
day and I
point.
could be neutral and be like, hey, 2% is 2%. Or you don't want it, give it to me. I'll get. But I can't take away that emotional impact that you have
Right. You have to
by
weigh
giving
all
you
these
2%.
factors, the psychological factor, and I think that's what separates the men from the boys, so to speak, when it comes to financial advisors, or the women from the girls, because
Right.
that's the thing. You're taking into account their emotional needs as well, whereas most advisors are like, "No, and don't you gotta make this choice because, you gotta take the 2% regardless of your feelings because, in the back of their minds, they want that business because they make a percentage or a fee off of how much they have invested."
Yes.
So, if they're paying off the mortgage, that's money they're not getting in the investments that they,
Right. Right.
get fees for managing. So I think that unfortunately, there are a lot of advisors out there who would always push you toward the thing that's going to get them more money. But there are advisors that are fiduciaries that really they want an ongoing relationship with you and want to do what's in your best interest overall. And that's like yourself, obviously, Dan. And I know that you really stress that. So.
Yeah, you can make the case. You can make the case that you should not pay off your mortgage because you're gonna make 2% extra. And
Right.
it could be a solid case, and then a
Sure.
reasonable person would say, "Yeah, that makes sense." You could also make the case that I'm gonna forego that 2% advantage so I don't feel stressed out. You can go either way with it. The question is, are you having that conversation with your advisor, or is it all numbers? At the same time, you don't wanna be overly emotional about it. You need someone to say, "Hey, no, 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 hold on. Yeah, I know you're gonna feel good about it, but you're gonna pay more in taxes, you're gonna have an excise tax. Like, maybe we should think this through and run the numbers."
Yeah.
And I have had clients have these conversations, and I've had clients choose to pay off, and I've had clients choose not to. Who's right and who's wrong?
Mm.
Neither. They're happy with their decision, which is my job to make sure that they're comfortable and are aware of all the factors. That's really it. So it's not so much you got to have someone that's looking out for your best interest. That's true, but you also have someone that's actually factoring in non-financial aspects of your life,
Mm.
such as stress reduction, and
Sure.
that's where I'm a big proponent of. It doesn't make me rich, but it makes my clients happier, and then they
Yes.
stick with me longer, and so I win in the end that way too because
Yes.
they stay
Makes
with me,
sense.
so
Yep. That
yeah.
makes sense.
So there is no right answer. The math says one thing, life satisfaction says another. You just have to consider all the factors. So consider the math, consider the non-math factors, and then make a decision, and once you make that decision, don't regret it, don't think twice. I'd say this, the people that paid off the house haven't come back to me and said, "Why did I do that? I wish I didn't have debt. I wish I had debt," right?
Yeah.
At the same
Yeah.
time, the people that are doing it say, "I'm so glad that I didn't pay it off because now I have more liquidity and now I have," right? So
Yeah.
people I don't want people to regret this decision. It's a big one though. So the only way to not regret is to make sure you have that conversation and have all the
And
factors.
yeah, work with a financial services professional. Don't do it on your own because they can keep you from maybe making overly emotional decisions, and make sure you have looked at the math before you make a decision.
Right. And if you're gonna talk to a mortgage broker and get the advice from them, just remember that. Like, what is their goal? To
Yeah.
have you pay off, right? Like,
Right.
no.
No.
They'll want you to refinance or keep a debt or a mortgage servicer, right? So you always consider that when you're getting advice. But yep,
Consider the source. Yep.
consider the source. But so is there an answer, Tony? No, that's boring. But that's what I'm used to. It depends,
It
right?
depends. Yep.
I'm gonna be saying it depends until I'm wearing Depends, I think. Yeah.
Oh,
No right
Dan.
answer. On that note, let's bring in my kids. Enjoy the rest of the day, everyone. If you got questions about whether or not you should pay off your home mortgage, you want to talk to someone about it, give me a call. I'd be happy to have it. Otherwise, enjoy the rest of the day. Thanks for another good show, Tony.
All matters discussed in today's show are for informational purposes only.
This show is not investment advice.
Dan Riddle nor Dolphin Financial Group are affiliated or endorsed by any government agency.
Investment advisory services are offered through Dolphin Wealth Management, Inc., a registered investment advisor in the state of Florida.
Insurance products and services are offered through Dolphin Insurance, Inc.
Dolphin Wealth Management, Inc. and Dolphin Insurance, Inc. are affiliated companies doing businesses as Dolphin Financial Group.
You should talk to someone at Dolphin Financial Group before implementing any of these strategies or ideas.